Hey everyone, and welcome back to the Scholar Advising Podcast. Today we're tackling a few questions we've been hearing from clients. We'll talk about planning strategies ahead of the 2026 supposed estate tax exemption sunset that could happen this year. We'll talk about what to think about when holding stock in a private company that could IPO, and how to approach umbrella insurance companies that want you to move over all of your insurance policies for the umbrella. And as always, we'll finish up with a rotating special segment. This week, we're defining the term of the day to help clarify one more piece of the financial puzzle. So let's get into it with our first question. So our first question today, we're considering setting up an irrevocable trust now that the estate tax exemption is supposed to drop in 2026. If we do it this year, do we lock in the current exemption? And how should this fit into our overall gifting goals to our children and grandchildren? So some background on this. The Tax Cuts and Jobs Act came out. These were the now infamous Trump tax cuts. Part of that was an increase in the estate tax limit. So the idea is that you used to be around $13 million per person on the estate tax limit of basically money that you could have in your estate that would not be taxed at the federal rates. That was doubled to 26 million before America. Right? So if we have this situation of $26 million, then the big question that keeps coming up, just like you asked here, is if I go gift $5 million this year to my kids, does that lock me into the higher estate tax exemption? And the answer to your question is unfortunately no. The way that it works is you have until the end of this year to gift, but you would have to gift above the amount that it's going to drop to next year in 2026 for you to get that bonus gifting, if you want to think about it that way. So in other words, if you went today and let's say you have married couple, $26 million as an exemption, and next year it's going to drop back down to 13. If you gifted $10 million today, then next year nothing changes for you. Your exemption cap just dropped from 26 to 13. So now you only have $3 million left of exemption, as opposed to having a $16 million left of the exemption there. Now, that could be problematic depending on how much you're wanting to give. That's quite a big number to gift over. If you really wanted to take advantage of it, then really the bonus gifting that you would have would be anything over the 13 million. So if you went and gifted 20 million, then there wouldn't be a clawback on that additional $7 million that you gifted. That would be your bonus gift that you were able to give without any gifting implications from a tax standpoint. Now, the question there is whether or not that it will sunset. That is being hotly debated right now of what that limit will be, whether or not, more importantly, whether it will be made into a permanent number. So that way we don't have to worry about every few years that number being shifted around. Say one of the big misconceptions with this, if you're thinking this applies to you when it comes to the estate tax limits, is the estate tax limits, unlike taxable income, grow by inflation. So because they're growing by inflation, the real dollar amount, you may be saying, well, I'm going to have an estate of $30 million, right, 30 years from now. But when you actually back that out, it's probably the estate tax limit will continue to increase over time by inflation. So really you need to look at what's the current value of the gift or the estate that you would have in the future. What would that look like today? So 30 million, maybe $13 million today, and the estate tax isn't anything that you have to worry about anyways. So those are the big ones there. If you're considering setting up the irrevocable trust to be able to take advantage of this, just know that you would have to exceed the old limits to really take advantage of that bonus gifting that you would have. And of course, that comes with lots of implications, some of which we've covered before on gifting and implications of that. But the first thing I always recommend when you're doing any of these strategies is really look first at, does it fit for your personal financial plan? It's really easy for a lot of things to have a scenario where the tax tail wags the dog type of scenario, where everyone focuses only on saving taxes and forgets that you're about to give a bunch of money away to an irrevocable trust. Make sure that's not money you need for your own lifetime and from a spending perspective. And we'll move on to the next one, which is one that I hear so often, right? And this is looking for recommendations on a umbrella policy that does not require all of your policies to be rolled over together. And this in particular is looking at a $75 million umbrella policy. And the situation that we run into with these umbrella policies is that the insurance company is really creating a second line of defense for all of your assets and your personal liability. Your first line of defense is going to be your car insurance, your home insurance, and the other insurance you have. Now, anything on top of that, the umbrella policy would take into effect. Now, the risk to the umbrella insurance policy or the company is they may come to me and say, we're going to give you, or you have this auto insurance policy over here, but they're not insuring it. So they want to make sure that that insurance company actually is going to do their job of paying out the amount that's needed if there was an accident or there's any personal liability issues. And then they would kick in, right? The risk to them is that I have a bunch of insurance carriers that actually aren't that great, that aren't going to pay first as that first line of defense. And then they're going to be stuck footing the bill on the other side. So a lot of times, especially when you start dealing with large insurance policies, the company will come in and say, we'll be happy to insure you from an umbrella policy, especially a big umbrella policy, but we don't want to rely on some other first line of defense before we get there. We need to make sure that we own the policy on the boat and the house and the vacation home and the cars and all of these things. That way we know that there's quality there for the first line of defense, and we're not going to be kind of stuck with the bill for anything under the limit that we're supposed to be taking on. So that's really why they do it. Now, there's other reasons there as well. Obviously, I'm sure they would love to have you as a client and have all of your insurance policies under one roof, which makes perfect sense. But usually that's the point that people stop at. They say, well, they just want all of my business there. That's absolutely true. They do want all of your business. They want to pull it all together under one roof, and they want to handle the home policy and the car insurance and everything else. But there are some legitimate reasons for why that may be something that they're wanting. And a lot of that has to do with risk mitigation for them. How the question really becomes when you start dealing with policies of this size is whether or not that amount of policy makes sense for you. So generally, when you have umbrella policies that are $1 million, $2 million, $3 million, they're relatively cheap, right? You're talking about maybe $150, $200 a year per million that you're dealing with. When you start to get above that $5 million mark, what you'll find is a lot of companies, a lot of your normal kind of run-of-the-mill insurance companies won't cover you anymore for that, for the exact reason we just talked about. That's too much liability issues. It's not really a volume game at that point that they're playing. So your State Farms and Geicos of the world, right, will likely cap you out at a relatively low number. And after that, you have to start going to other companies like a Chubb or a Pure Insurance that are used to dealing with larger umbrella policies. They do a little bit more due diligence. So they're going to start doing a deep dive with your policy. You're looking at 75 million or so. They're going to want to dig into the weeds of what type of exposures do you actually have? And they want to know why you think that you might be personally liable for $75 million. And sometimes that can be hard to justify, but if you have a lot of real estate holdings, especially on the investment side, if you have a lot of business holdings, if you're kind of out in the media often or in the public eye, that becomes more of a concern. You become more of a target for these things. So all of those things known as exposures start to add up, and they want to know what those exposures are. They want to know where you get your money every year, so they'll look at tax returns. They want to know what types of things you're invested in. They want to know legal history. They want to get into the weeds there, which sounds kind of odd because it's a lot different than calling up your local insurance agent and saying, just, can you add $1 million of an umbrella policy? Them saying yes and checking a box. Right? It's a much deeper process. And these policies can be extremely costly now compared to the protection it provides, not as much. But these are big deals that are being done for the insurance company and for you as well. So you want to make sure that's a good fit there. But to answer your question, I think it's going to be rare to have a insurance company gladly take on anything above really $20-30 million of an umbrella policy without wanting to see everything, right? And with them seeing everything, it would really surprise me if they're going to be okay insuring that much liability without having a lot of confidence in the underlying policies. Now, the advantage to you is exactly what I just mentioned, that this is a large policy for most insurance carriers. So you do have a little bit more negotiating room there. And if you can justify which policies that you have and whether or not they do meet the standard that that insurance company is looking for, then maybe that's the discussion. of saying, I have this coverage on the house, I have this coverage on the car. What is your concern that you need to have all the policies? Is that just a strong recommendation, or is that required? And if it's required, which one of these is your biggest risk? And which ones can I move over to your insurance company so that way that mitigates that risk and we can do this deal for you? And for our third question, we own stock in a private tech company that might IPO next year. What should we be thinking about now for taxes? So lots of mights here, but it's a good situation to be in. A company might go public. A lot of it has to do with how much control you have in that company and what type of ownership you have and the size of the company. And I'll go into each one of those. So if you are a minority of minority shareholders, right, and you don't really own anything, it's a big part for you, right? It's a big piece of net worth on your end, but it's nowhere near the, let's say, billions and billions of dollars the company's worth that's going to IPO. There's not a lot you have to play with here, right? At least on the company side, because you're not going to be able to go in there and implement certain policies or implement changes of how the actual sale happens and what stocks are given and everything else in the IPO. Now, in most cases, what will end up happening is you start looking at what kind of stock you own. So if you have just ownership in the company, if you have options, whether they're ISOs or NSOs, that starts to matter a lot more. And each of those had different time limits on them of when you exercised and what the tax implications can be. So it could make sense if it might IPO in the next year. It sounds like that's probably the rumblings. That's the goal. And sometimes we have to watch out for those too, because everyone's plan, or it seems like recently, was the IPO until the market cools down. Whenever the market's hot, everyone's going to have an IPO, or everyone's being bought out by private equity is what it seems like. So we want to take that with a grain of salt until we have some quality proof there that that's the case. But there are things you could do. One of those scenarios are you could consider exercising options now. So that way, by exercising the options now, you hold the stock. And as long as it's after a year, then it would qualify as long-term capital gains, which is significantly cheaper from a tax perspective. So that's one. Depending on the size of the business, if the business assets are under 50 million, you can get into the QSBS deductions or the qualified small business stock exemptions, which basically allow you to exempt up to $10 million of capital gains on a sale. But there's some really specific requirements there. Things like how long you've owned the stock. It has to be owned for 5 years. And I think assets are 50 million or under. So there's very specific situations. Definitely something worth looking into if that starts to sound like your situation, where the company isn't very large, but it's going public and you've owned the stock for a while. You didn't just join this year, past couple of years. Then that could be a massive exclusion there on capital gains on $10 million. There's also the option of what's going to happen to your shares after. So let's say you go public and now you have shares that are converted over into this new publicly traded stock and you've seen a large increase. Depending on where you are on the corporate ladder, so to speak, you can start looking at things like 10b5-1 plans, which would be likely required anyways, because that's going to be a requirement that essentially a form that gets filled out that says, hey, I have some insider information on this company, so people should know when I'm selling stock and have that approval, which is going to be required for publicly traded companies there, especially with material insider information. So if that sounds like you, then what you could start doing is slowly exiting that stock after it goes public. And what that'll do is avoid one big windfall of cash and instead slowly really separate it out over multiple tax years, so that way you're not going to deal with it. That may be a good idea, that may not, depending on what you think is going to happen to the stock price after it goes public. Generally, stock prices drop after an IPO, which people don't think about. That's another misconception that's out there, is that a company goes public and the stock price jumps. Usually it jumps in the primary market. So your price may jump from where you own it now to what it actually goes public for and what it's listed at. But whatever it's listed at, for me to go and buy that stock once it goes public, the odds are within the next year it's going to drop in value. So there's always a risk there. There's IPO underpricing, right? Basically, the company's investment bankers will give a good deal to whoever's buying your stock or the company's stock up front. So that way they keep coming back as repeat customers. So you're going to see the stock price go up for you. They're going to make a ton on whoever had that initial purchase from you. in the market. But the secondary market, in other words, from whoever bought it from the company and me or somebody else, those prices usually aren't that great. So that was always a big issue. I remember when Facebook went public and there was all this excitement around Facebook going public and how it was going to change everything. And everyone was excited to buy the stock the day it went public. But that's the issue, is the company already went public before we have an option to buy it in the secondary market. At that price, you didn't get the run up. You get typically the fall afterwards buying in the secondary market as a traditional investor or retail investor. We've talked about DAFs and we've talked about charitable remainder trusts, but DAFs are a good option to start considering. Really starting to put a plan together and saying, if this does go public and if we end up with a big windfall and we're trying to mitigate taxes, how much of this money will I need and how much of this money could we push over to a charitable trust or a donor advised fund or something, because that's going to give you an immediate tax benefit that year. But that's always a really tough decision to make in the moment, because you look at it and say, all right, well, I just had a windfall of $15 million of stock. I could sell it right now and be done. And you're playing this game of you could donate anywhere from 0 to 15 million. So do you donate all of it? Do you donate half of it? Do you donate only 1 million? And of course, there's differing incentives there. The more you give, the more your tax break is, but the less money you actually have to live on afterwards. So you play this game going back and forth, and that's not a fun game you want to be playing after it happens. That's a good thought experiment to do before the IPO, so that way you have an idea of what is that number that you're looking for and what can you plan for. That way, when it does happen, or if it happens, you have something in your mind that says, you know what, this could work. This is the number that works for me, and this is how much giving to charity makes sense for me. And now it's time for our rotating special segment. This week, it's term of the day. So we'll break down a common financial term and bring a little bit more clarity to the financial planning process. So let's talk about FLPs, or family limited partnerships. So these are really neat, and I think they commonly are looked at as something that's really complex, but it's actually solving a really simple problem. And the problem is, let's say I own business and real estate and all of these things, and I want to continue gifting to my kids. And you look at the gift limit, say, this sounds great. I can gift $19,000 per kid. Then you continue this process, but that requires you to take your own cash and gift to them. But all of your assets are tied up in business ownerships and real estate and everything else. So how can you effectively gift to them without selling off the real estate or selling off the business, which has its own tax implications and problems there? So one of the possible solutions to this problem is known as a family limited partnership. Think about you and your family all basically getting into a business agreement together and saying, we now have this partnership. The real estate investments we own are in the partnership. The business that we own is in the partnership. And typically it's mom and dad are the general partners on this. So they make all the decisions. They take on the liability of it. So nothing's really changed there. But what changes is the kids now have an ownership stake. And what you can do is every year you gift, instead of $19,000 of cash, you give them $19,000 of shares, so to speak, in the family limited partnership. So by doing that, their ownership every year increases in this collective basket of assets. So it makes it a lot simpler to gift. It makes it a lot simpler for succession planning, because what's also happening, every year they own a little bit more of the business or own a little bit more of the real estate. That means they have a little bit more added responsibility to it. They get to see a little bit more about how the business is structured. They're still not making decisions yet, because that's the general partner's decision. So you're still able to maintain control of the assets and the decisions that are made, while also relinquishing some of the ownership to be more favorable on the estate side. Now, the real big bonus of this that is not necessarily overlooked, but one that's misunderstood, is this concept that you get a discount on the business. Once you put those assets into the family limited partnership, the IRS typically allows a discount to be put on them. And what I mean by that is it says, you owning a piece of property over here may be worth $1 million. But as soon as you put it into the family limited partnership, the value of that property drops, especially from a limited partner perspective. Because as a limited partner, in other words, one of the kids, they have no control over this asset. Sure, they were gifted $19,000 of this property, but they don't get to make any decisions on it. They don't get to sell it. And it's something that's hard to market. There's a liquidity discount as well. they can't just immediately go sell the family business tomorrow. That would be extremely costly, and they make no decisions over it. So think about a scenario where you own part of a business where you get a say in what's going on, and you own a part of a business where you don't get any say. The one where you don't get any say has a lower value, and the government recognizes that it has a lower value. So while you gift $19,000 to the kids of value in the business, the percentage of the business they own actually is higher than the $19,000 you would have had before. And it's basically giving it to them at a discount. So they're able to own a larger percentage for a smaller amount of buy-in, which would be the gift every single year. Now, the downsides of this, because some people look at this and say, this sounds fantastic, right? It's like, Stefan, sign me up, put all the assets into a family limited partnership, and let's start just gifting out to the kids all this ownership every year. So typically you want to have assets that are a little bit more complex, a little less liquid. That's where typically we see this with businesses. We see this with real estate. We see this whether it's second homes or vacation homes or just property that you want the kids to have access to. So you're able to start gifting them pieces of this, taking the liquidity discount. But as you can imagine, anything that starts to sound this good comes under IRS scrutiny as well. So record keeping is important, right? You need to make sure that you're paying additional fees for attorneys, or accountants throughout the year to make sure the books are properly kept, the minutes are properly kept, and the business is running as a business, as this partnership, to make sure everything's in order. And the benefits can be great. So it's worth spending the additional time and money to make sure it's done appropriately and within the laws of what is required for those cases. All right, so great for high amounts of assets, especially business or real estate, but not great if the benefits of doing this don't outweigh the costs associated with all the record keeping and the upkeep of getting a new partnership formed and then everything titled inside the partnership. And that's all we have for today. Thanks for listening. Hey, this is Stefan Scheit. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, just send us an email at podcast@scholarfinancialadvising.com. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.